Hello, everyone, and welcome to Nova's presentation, Introduction to 401k Plans for Plan Sponsors, with Charlene, DeMartini, and Christine Hall. If you have joined us for any other webinar, you may have noticed that our GoToPanel platform got quite a bit nicer, a little makeover. With this new update, it should make it a little bit easier for you to spot where to go if you have any questions. You may find that on our panel. You will see a icon at the top right-hand corner with the little pop-up message that has a question mark. Here you can enter in any questions you may have for our speakers. Keep in mind our Q&A portion will be held at the end and they will answer as many questions as time permits. If time does run out, you can email us webinars@nova401k.com and we will forward those questions over to the appropriate person and get your answers over to you. Right next to the questions icon, you will see what appears to be a paper with a paper clip. This is going to be your handouts icon. You will be able to find today's material in PDF form. If you are unable to view or click on the handouts, you can go ahead and send us an email and we will provide you with that PDF. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our pop-up survey. This is going to allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, and that is www.nova401k.com/webinars. Thank you again for joining us today. I would now like to introduce from Nova's MEP team, M&A Account Manager, Charlene DeMartini, and from our East Coast 2 team, Senior Defined Contributions Account Manager, Christine Hall.
Thanks so much, Yvette. Welcome, everyone. Thanks for joining us as we go through our introduction to 401k plans for plan sponsors. Charlene and I are going to be spending the next approximately 90 minutes with you. Because this is an introduction webinar, we're assuming that there are some of you that have a brand new 401k plan. That's exciting. Congratulations, and we hope that this will be informative to get you started with your new plan. Before we jump into it, just wanted to go over our disclaimer. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. And as Yvette had mentioned, this is available for continuing ed credit. If you need CPA credit, there's Nova's provider number. We're assuming that you are already registered individually. You need to be present for the entire webinar. There's an evaluation at the end. Complete that, and then you'll receive your certification within 1 week. We do have a big agenda for today. Just to give you an overview of where we're headed, we're going to go over roles and responsibilities for a 401k plan, talk about Nova's cybersecurity measures, go through some 401k basics and moving pieces that take place in a 401k plan, distribution basics, loan basics, and finally we will end with our annual calendar, and that will give you an idea of what a year and your 401k plan working looks like. All right, so to start off with the roles and responsibilities. 401k plans have a lot of things going on. There's some very specific things, niches, if you will, in 401k plans. So, it does require a number of different specialty areas. Mostly who you're going to be working with as a plan sponsor are a financial advisor, an investment provider, and a third-party administrator. So I want to go over those roles with you. We'll start off with the plan sponsor. That's you. You decided to set up a 401k plan for your employees. You have the overall fiduciary responsibility of the plan. It is your responsibility to communicate your plan to your employees. It's also your responsibility to remit the contributions that your employees might decide to defer to the plan to the investment provider. And you also need to provide your annual data to your third-party administrator each year. The second role in a 401k plan is the financial advisor. That is also sometimes known as a broker, and that individual will help you as the plan sponsor select a vendor where your money is going to be invested and to monitor if being at that vendor makes sense. They will coordinate enrollment meetings for your employees, provide investment education for your employees, and they will assist you with choosing a fund menu for your plan that is within 404C compliance. And what 404C is, that states that 401k plans have to have a fund menu that offer a variety of different types of funds so that the participants can have a well diversified options to invest the money in their plan. And then we'll go down here to investment provider. That is sometimes called the record keeper. That is the financial institution where the money for the plan is actually held. It's the custodian of the plan assets. This company will invest your plan contributions and provide daily record keeping for your plan. So your employees and all the plan participants will be able to go onto their website and see their accounts on a daily basis. They also provide statements for the participants. Those statements could either be delivered to the participants electronically or by paper through mail, and they will be distributed at least quarterly, if not more frequently. This is also where participants will go when they need to request a distribution, and it's where you as the plan sponsor will go if you need any reports on your plan, or where we as a third-party administrator might go to get the reports, the annual reports that we need from the investment provider. Then finally, we have a TPA, which is the third-party administrator, and that's NOVA. And what we do for your plan is we prepare and maintain the plan document. All qualified plans are required to have a plan document, so that is part of the TPA's role to help keep that maintained and up to date. We complete the required annual testing for your plan. We're going to go over some of those tests in this presentation, but that is a role that we do as your third-party administrator. We prepare annual filings for your plan, and particularly the Form 5500. Again, we'll go into more detail on that. And we provide ongoing plan consulting for you. So if you have any questions about your plan, you'll want to reach out to your account manager here at NOVA, and we can get you in the right direction. Now, before we jump into specific 401k information too deeply, we do want to go over NOVA's cybersecurity measures. What you're going to see as we're going through things is that there's a lot of confidential information that NOVA's going to need as your third-party administrator. We're going to need things like names, social security numbers, date of birth, addresses for your employees. So we want to make sure that you feel comfortable with the security measures that we have in place. There's a lot of money in 401k plans, and certainly as we have up on this slide, the bad guys have taken notice to that. And as a result, they do try to get money, and particularly from record keepers. And this could start as a phishing hack in one of your employees' emails. Then they might contact the record keeper, reset the password, and the next thing you know, they can request a loan or distribution. Obviously, we want to try to prevent that from happening, because this kind of theft is often very difficult to recover. And this type of theft is also not covered by things like your fidelity bond, your fiduciary insurance, or your E&O insurance. So we all need to be alert and do our part in preventing fraudsters from succeeding. Like I said before, Nova is going to request information that has confidential information on. The record keeper will likely too, as part of your payroll files. But when we're talking about things like census files, deferral files, payroll files, and address files, and also non-discrimination testing files have confidential information on. And that testing are the tests that Nova will prepare for your plan. Annual valuation reports also have confidential information on them. Tax forms. If you ever need to send Nova a copy of your W-2 forms, K-1s or Schedule Cs, none of this information on this slide should ever be sent via email without encryption. And in fact, Nova even has a secure file exchange that you can use. That is the preferred way to get this information to Nova to prevent those email hacks and phishing that might occur. Our secure file exchange is through our plan sponsor link. Right there is the address to that. What you'll find with when you're working with Nova is that your account manager here at Nova should have a link at the bottom of their email that takes you directly to our plan sponsor link, where you can log in and then you can use the secure file exchange to send us the files that would have confidential information in them. And we want you to do that rather than send them through regular email, just as a way to keep that information protected. The other thing that Nova does is we do have encryption on the software that we use. So in that way, we're very careful with all the information that we have stored about your plan and your employees' confidential information. If you are set up on Nova's contact list, we can talk to you openly about your plan. But let's say you'd hire someone new in HR, or someone that might be working with your plan. If they would ever reach out to us and say, hey, I'm new at so-and-so company and I'm going to be working with you on this plan, we would never just automatically start giving them information about your plan. We would have to have authorization from an existing contact before we add anyone to our system. So we're very diligent about that. Nova also has mandatory training for all of our associates each quarter, just so that we can stay on top and be diligent about being careful with the information that we receive. We also have a password policy where all passwords are changed at least every 90 days, because we want to keep all this information safe and secure. What you can do as the plan sponsor to help us to keep your information secure is to, like I said, use that upload function on our plan sponsor link to submit your annual census, distribution information, anything with sensitive information on it to Nova. You want to limit the number of people that are copied on emails. If someone doesn't need to be on an email, don't copy them on the email. That'll also keep things more secure. And you also want to use complex passwords and change them often. And you'll see right here how passwords is written. And, so if you use a common word like passwords, you might want to put some specials in there to make it a little bit more trickier for someone to figure out that password. All right. So now that we did some of those 401k some of the cybersecurity information, we're going to jump into the 401k basics. 401k plans are set up to be an easy way for employees to save for retirement. The way they're set up, employees should be able to choose a deferral percentage, a good way to have their money invested. And, if they're contributing at a high enough level when they pick that deferral percentage, they can really just set it and forget it. Just look at it periodically, and it'll be a great way for them to save for retirement. Studies have shown that that kind of payroll deduction is the best way to save. And in fact, it's so good that for many people, their 401k is their biggest asset outside of their home. 401ks have become the primary retirement plan for most people, and so it really is a valuable employee benefit. On the flip side, even though 401k plans are designed to be easy for employees to save, they're not necessarily designed to be easy for employers. There are a lot of regulations that go along with 401k plans, and those regulations come from the IRS and the DOL. And common sense doesn't always help you to make decisions with a 401k plan. The rules change frequently. The government's always passing laws and changes. So there are things that need to be kept up with. And in most cases, your written plan document is going to control what your plan can do. So that is very important too, that is kept up to date. So how the IRS impacts 401k plans, your 401k plan needs to stay in compliance with the federal statutes and IRS regulations. Included with those regulations is the requirement for annual non-discrimination testing. So each year, you have to prove that your plan was non-discriminatory by having these tests completed. And those are tests that NOVA will complete for your plan. You have to be aware of taxable events and deduction limits, because the IRS looks at that, because that's how they get money from the plans. The plan document needs to be amended timely, and the terms of the plan document need to be followed. Those are all things that the IRS looks at in regards to 401k plans. The Department of Labor, they look at plans a little bit differently than the IRS does. When they look at a 401k plan, their role is to make sure that employees are being treated fairly and according to the plan. As a result, they're going to make sure that 401k contributions and loan repayments are deposited into the plan timely, that the plan offers a good fund lineup for participants so that they can have a well-diversified account. They're going to be looking at the expenses that are paid by the plan and if they're reasonable. And the Form 5500 gets directly submitted to the Department of Labor. Now, I did bring up the plan document and the importance of it. It is important to both the IRS and the DOL. That really is your rule book for your plan. So if your plan were ever to be audited by the IRS and the Department of Labor, one of the first things, if not the very first thing they're going to ask for, is a copy of your plan document. Your plan document addresses your plan's eligibility rules, the entry dates that your plan has, what compensation your plan recognizes, how employer contributions to the plan are calculated, and also your plan's vesting schedule. So if you ever want to make any changes to any of those items, you need to make sure that the plan document's also updated and it is always good to contact your account manager here at Nova when you're thinking about making any changes. Plan documents need to be amended timely. So from time to time, the IRS will say all plans need to be restated because over the past several years, we came out with new legislation, and we want that to be in all plans. Now, typically, that is about every 6 years that the IRS requires those restatements. So that needs to be made. That is something that Nova keeps track of for your plans. If your plan's amended, it needs to be executed timely. There are certain features that your plan might want to offer that if you don't have them in place prior to the beginning of the next year, they're not going to be able to take place next year. You might need to wait another year till you can make that change. And there are penalties for failure to execute timely amendments. So if you ever want to make any changes to your plan, you do want to proactively reach out to your Nova account manager for that. Now, I did say just a little bit ago that sometimes things in 401k plans aren't logical. So I wanted to give some examples of how that could be the case. So this first example, a plan sponsor wants to exclude hourly employees from his 401k plan. Well, that seems reasonable. That's an easily identifiable group, and it could be easily desired not to have a certain group that's easily identified as part of the 401k plan. Well, first, before that can take place, the plan document must be written to exclude the hourly employees. If that exclusion is not in the plan document, then it is not a plan exclusion. So you want to make sure, again, with that plan document that that's in place. And then the other thing is we'll find out there's different testing involved, in one of the IRS tests is coverage testing. And if excluding hourly employees from the plan doesn't allow your plan to pass that IRS coverage testing, it's not going to be allowed. So anytime you're thinking of a change on how you might want your plan to be administrated, make sure you ask so that we can be sure that everything lines up legally for your plan. Second example, here's a question. What is the preferred investment alternative for an employee who puts money into a 401k plan but fails to make investment selections? So you might ask, well, how does that happen? If someone chose to make deferral contributions into the plan, wouldn't they be required to make an investment, fund choices? And you're right. Usually the record keepers will require that as part of their online enrollment process. But you might get into a situation where an employee who's eligible for the plan needs to receive an employer contribution and never actually signed up for the plan, but they are eligible. So they get an employer contribution into the plan, and then it's found out, oh, they never made an investment choice. So what do we do with the money? Well, according to the Department of Labor regulations, the money needs to be invested in a balanced fund or a life cycle fund. Now, that might not seem logical because you might say, well, wouldn't it make more sense to just put it in a money market or a stable value fund until that person makes their own elections? But that is not considered to be prudent by the Department of Labor because there's a potential that that individual might never make an election and could have their money in the plan for years. And if they're in a money market or a stable value fund, then they're not keeping up with inflation. So They want the default option to be either a balanced fund or a life cycle fund. Okay. So the other thing that's really important is the timeliness in the deposits of 401k contributions and loan repayments. And that the Department of Labor does look at that. If your plan's a small plan, and a small plan would be any plan that has less than 100 accounts in it. So 100 participants with account balances in the plan. If it has less than that, it's considered a small plan. And back on January 14th, 2010, the Department of Labor issued final regulations that say that you need to have those contributions into the plan as soon as administratively possible, but no later than 7 business days after the pay date from which it was withheld. So that's very important that you making those deposits into your plan part of your payroll process, because the sooner you can get them in, the better. Now, if you have a large plan, and that would be a plan that has more than 100 participants with account balances, the Department of Labor has not issued as clear of rules for those type of plans. They just say, we want you to have it in as soon as administratively possible. Now, there is an old rule that sometimes gets brought up, and that is end the 15th business day of the month following the pay date from which they were withheld. Again, that is an old rule. Really, the Department of Labor hangs on that as soon as administratively possible, because they want, just like for small plans, they want you making these deposits to be part of your payroll process. So sometimes large plans will, figure, well, we'll stay within that 7 business days. But really, the Department of Labor holds large plan sponsors a little bit tighter to this. And I have seen them typically wanting to see that go in within 3 to 5 business days. And I've never seen them be okay with that 15th business day following the month. So make it part of your payroll process to get the contributions in, set a pattern. That's what they're looking for. Sometimes even if they find like an outlier from that pattern, they'll want a correction made. So that's a big issue with Department of Labor audits. It's also for large plans an issue with your CPA audit. When you have a large plan, your plan needs to be audited by a CPA on an annual basis. They're going to be looking that those deposits were made timely. And if they feel like there were any late deposits made, they'll want you to go through the correction process. The Form 5500 also needs to be submitted to the Department of Labor. The Form 5500's an annual report for the plan. Some people kind of liking it to a tax filing form, and it's similar to that. It does have all the financial information for your plan, participant counts, the fees that were paid for your plan. It's all done on a plan level basis, though. Nothing is at a participant level. However, all money that is in 401k plans is tax deferred, so it's not really a tax form that's reported to the IRS. It is reported to the Department of Labor, and it is required to be electronically filed, and that is a form that NOVA will submit for you we'll prepare for you to submit to the Department of Labor on an annual basis. One of the things that are required on that Form 5500 is your plan's fidelity bond amount. So you want to make sure that your plan is covered by a fidelity bond because the Department of Labor is looking at that. If your plan is a large plan, meaning, again, you have 100 participants with account balances, you're also going to need to attach a copy of the audit report that an independent CPA prepares for your plan. Now, there are some transition rules between that large plan, small plan. If your plan hits 100 participants with account balances, that doesn't mean that it's automatically going to go from a small plan to a large plan. The Department of Labor does give you until you reach 120 participants with account balances. So that way, when you do hit the 100, you know that the audit's coming. You can look and see if there's any former participants that might be able to have their accounts cashed out of the plan, or just, be preparing for that audit that's going to be coming up. The participant count is determined as of the first day of the plan year. So if you have a plan that goes on the calendar year, it's going to be the number of participants that you have with account balances as of January 1st. And it wouldn't be just employees with account balances, it is truly participants. So if you have former employees that still have accounts in the plan, they do count towards that number. Likewise, if you're a large plan and your plan drops slightly below that 100 participant mark in a year, you can remain a large plan with an audit as long as you have at least 80 participants in the plan. That's helpful because, if you just drop right below it one year and you know that you're going to be up above it the following year, the consistency of having your plan audited will also save time and potentially money. So those transition rules between the 80 and the 120 are helpful with knowing whether your plan will be a small plan or a large plan. Next, we want to talk about payroll integration and what it is. Your payroll provider under payroll integration will submit your full census to your record keeper each payroll period. That's typically what the record keepers want so that they can keep up with things with your plan. That file that's going to be submitted includes addresses, dates of birth, dates of hire, dates of termination, compensation, deferral amounts. And it includes all of your employees, regardless of whether or not they defer. And that's really important. You want that record keeper to be receiving a full payroll file for your plan, because that'll help them to be able to recognize new employees as well that will become eligible for your plan. Now, why should you use payroll integration? Well, it allows the annual census to be pulled by the record keeper, which is really helpful. Automatic distributions from participants can take place. If the record keeper knows that someone's no longer employed with you, they can go ahead and send out a distribution packet to that participant. And if the account is under $7,000 and the participant doesn't respond within a certain amount of time, which is usually 30 to 45 days, they can have a cash out processed for the account. So that is good, as far as keeping the numbers down in your plan and keeping track of things. The vendor might also be able to track enrollment. So once a new employee's data is received on your payroll file, they can send out enrollment packets once participants are going to become eligible for the plan. It also updates things with the vendor, like participants' addresses and if you have any rehires. So there's two different types of payroll integration. The first one is Payroll 360, and that's when census data flows both ways. So census data will be provided from your payroll provider to your record keeper, so that they are updated each payroll date. And then likewise, when the record keeper, that investment, the company that holds your plan's assets, when they receive an update dated deferral change or hardship withdrawal request or loan request, they can communicate that information to your payroll company so that they get the deferral change and they get the loan repayment amounts. So it's really, if that's something that your plan's record keeper offers, it might be something that you want to look into, because it's a great way to have more hands off of that back and forth between your payroll provider and your record keeper. Another option is Payroll 180, and that's where the census only flows one way. And that's typically when your payroll provider is going to just be able to submit information to the record keeper, and the record keeper is not going to be able to directly give them information. They would likely give you, as the plan sponsor, the deferral changes, the loan repayments, and then you'll have to update your payroll with that information. Now, one of the reasons why you'd want to have this payroll integration is because it can eliminate some of these common payroll errors. And common payroll errors include excluding bonuses from deferral elections. So unless your plan specifically has in your plan's adoption agreement that bonuses are excluded from plan eligible compensation, then deferrals need to come out of them. So if you're not sure how your plan handles bonuses, you'll want to ask your Nova account manager, who can then look at your plan's adoption agreement and let you know how to handle that bonus. Another common error is excluding part-time employees from the plan. Again, if this exclusion is not stated in the plan's adoption agreement, then it is not an exclusion. So check with your account manager at Nova to see if there's anyone excluded from your plan, and even if that category, that classification of employee is allowed to be excluded from the plan. Another common error is matching catch-ups separately from non-catch-up contributions. So employees are allowed to defer a certain amount of pre-taxed and or Roth contributions each year. Employees who are at least age 50 during that year are allowed to do an additional catch-up contribution. When you're calculating the match, those two amounts, both the catch-up and either the Roth or the pre-tax, well, actually all three of those amounts should be added together, and then the match should be calculated. If you calculate them separately, you're going to end up giving that individual more match than they should receive. So all deferrals, including catch-up, pre-tax, and Roth, add them together, then calculate the match. Don't do them separately. Your payroll provider should be set up to do that correctly as well. Another common error is not distributing the summary plan description. The summary plan description is a document that all plan eligible participants need to receive. So whether or not they choose to participate in the plan, your employees who meet the plan's eligibility requirements need to receive a copy of the summary plan description. Not allowing new employees to participate in the plan. So if you have someone that meets the plan's eligibility requirements, and for whatever reason you miss giving them information about the plan, that is an error. So a correction would need to be done, a missed deferral opportunity correction. So you want to make sure that that's in place. Again, if there's integration between your payroll provider and the record keeper, some of those errors can be prevented. Not capping matching contributions based on the annual compensation limit. Okay. I'm going to give an example of that. So we will talk about that more in the upcoming slides. But first, I'm going to give an example of not allowing a participant to enroll on time. So we have ABC Company's plan has no age or service requirement, but does not offer Steve enrollment into their 401k plan for 6 months. So in this situation, the plan has what's called immediate eligibility. So on day one, they're allowed to start contributing to the plan. But for whatever reason, things didn't happen the way they should have, and Steve's not offered enrollment in the plan for 6 months. So as a result, like I said, a missed deferral opportunity occurred, and the ABC company will have to make Steve whole by making employer contributions for the missed deferrals and the missed match. And then the other one I wanted to show an example is not properly capping the match contribution. So in this example, it's important you need to know what your plan's matching formula is. And for this plan, their 2024 match is a 50% of the first 6% of compensation that an employee chooses to contribute to the plan. Okay? So this comes into play when you have some people that earn high compensation amounts. For 2024, the maximum amount of compensation that can be considered for plan purposes is $345,000. So any compensation that's made over that is not considered for plan purposes. So in this plan, if we want to know what the maximum match that any one person can receive, we take that maximum compensation limit for the year, the $345,000, times the 50% match, times the 6% of compensation that it can be matched up to. And so we get that the maximum match for 2024 for this particular plan's formula is $10,350. So if you have a match, and you might not have the same exact matching formula, check with your NOVA account manager if you're not sure what your annual match is. It will change each year, so it is a number that you need to keep up with. Initial eligibility. The maximum waiting period that any plan can make any employee wait to get into the plan is 1 year and age 21 with a minimum of 2 entry dates. And that's to participate in the 401k. A year of service is a year, typically it's a year in which at least 1,000 hours is worked. You can't have a requirement that's more than 1,000 hours. So you can require that employees have that 1,000 hours to count as a year of service, but you cannot require any more. And the age requirement cannot exceed age 21. Now, if you want your eligibility requirements to be shorter than 1 year, less than age 21, not have a 1,000-hour requirement, that is certainly okay. But those are the maximum amount of waiting time that you're allowed to have. The initial computation period for determining if a new employee is eligible for a plan is the 12-month anniversary from the date of hire. And then after that, it changes to the plan year. So to look at that, let's say we're trying during 2024 to determine when someone who was hired on June 1st, 2023 can get into the plan. So that person's 12-month anniversary is going to go from their date of hire, June 1st, through June 1st, 2024. We're going to look at that and see if that individual worked at least 1,000 hours. And if they did, they're going to enter on the next entry date. And if we only have semi-annual entry dates, that'll be July 1st, 2024. Now, let's say this same person did not work the 1,000 hours during their first 12 months of employment. The next period that we're going to look at is going to be based on the plan year. And so we'll look at the entire 2024 plan year, which we're still currently in. So after the end of the year, we'll see, did that individual work at least 1,000 hours during 2024? And if the answer is yes, they'll get in on the next entry date, which would be January 1st, 2025. If they didn't work at least 1,000 hours during 2024, we'll look at each subsequent year. So the next period will be during 2025. Did they work at least 1,000 hours? If at any time they did meet that 1,000-hour requirement, they are in the plan. All right. So dealing with rehires can be a tricky thing when it comes to 401k plans, because there are a little bit different rules depending on the rehire situation. I do strongly recommend that when you have a rehire, if it is not clear, totally clear to you how the rehire should be handled, reach out to your NOVA account manager, because rehire situations can be a little bit tricky. But I'm going to try to give you some rules of thumb here. So if a formerly eligible employee, so a former employee who met the plan's eligibility requirements, got into the plan, and as long as they had one single vested dollar in the plan, when you get into that situation, they never lose their prior service credit. And if they are ever rehired, a person in this situation is going to immediately be eligible for the plan on their date of rehire. Now, if someone's employment ends before they meet the plan's eligibility requirements and they've never had any money in the plan, they are in a different situation. They will keep that prior service that they earned until they have 5 consecutive one-year breaks in service. After they have 5 consecutive one-year breaks in service, they'll lose all their they will lose all their prior service and be treated as a brand new employee. So just be careful, when you're rehiring someone, if they were in your plan before, you're going to know that they're automatically going to be immediately eligible on their date of rehire. So you want to, before their first paycheck, make sure that they have an opportunity to make a deferral election and they know that they're right back in the plan where they were when they were employed before. Next, I want to go through the non-discrimination testing that's required for plans. And first start off with these 3 tests. The first one is coverage testing. And coverage testing tests the plan based on how many people are actually benefiting in the plan. So it is a straight numbers. It compares your highly compensated employees who are benefiting in the plan to your non-highly compensated employees. Profit sharing testing test the employer profit sharing contribution to see if it is being contributed fairly to everyone, and the IRS has testing that needs to be done to prove this fairness. Compensation testing is only in place if you actually exclude a type of compensation from your plan. So in that one example earlier, we were talking about excluding bonuses. Well, if you actually do exclude bonuses as plan eligible to your compensation, there is additional compensation testing that needs to be done to make sure that it's being tested fairly according to the IRS regulations. The next kind of testing that I want to go into a little bit more detail is the ADP testing. And that compares the amount of deferrals that highly compensated employees make to the plan to the amount of deferrals that non-highly compensated employees make. Failure to this ADP testing usually results in taxable refunds to highly compensated employees. So, who are highly compensated employees? Well, for 2024, anyone who earned more than $150,000 in 2023 is considered a highly compensated employee in 2024. So we always look back to the prior year. And that $150,000 is not a constant number. It does potentially increase slightly each year. But for 2024, we look back to 23, and the compensation limit for highly compensated in 23 was 150. Another way to determine if someone is highly compensated is if they are greater than a 5% owner. And if you are greater than a 5% owner, it doesn't matter how much compensation you made, you are automatically considered highly compensated. So even if you made under 150,000 in 2023, you're still highly compensated if you're a more than 5% owner. Anyone who is a lineal family member to a more than 5% owner is also a highly compensated employee. So that would be, a spouse, children, grandparents of 5% owners would also be considered 5% owners, again, no matter what their compensation amount that they make. Another type of testing required by 401k plans is top-heavy testing. And for top-heavy testing, we compare another group of employees, key employees, to non-key employees. And if more than 60% of the total account balances in the plan are held by the key employees, then the plan is considered to be top-heavy, and there will be requirements to make contributions to the non-key employees. Determining a key employee is a little bit different than a highly compensated employee, but somewhat similar. Again, anyone who is greater than a 5% owner is a key employee, and also anyone that is in the lineal family member to that 5% owner is also a key employee. But here in the middle is where it gets a little bit different. Anyone who's a 1% owner with compensation greater than $150,000, or anyone who is an officer with compensation greater than $220,000 is a key employee. Now, going over those ADP testing and top-heavy tests, you might say, oh my goodness, I don't know how we're going to pass those tests. Well, the IRS does offer a solution, and that is a safe harbor plan. Because if your plan is a safe harbor plan, it will automatically pass those two types of tests. The options for a safe harbor plan gives required contributions to your plan. You will either be set up to have a safe harbor matching contribution, and the basic formula for that is matching 100% on the first 3% deferred by employees, plus matching at 50% on the next 2%. That's the basic formula. There are some variations that can be had. That is a required contribution. Or you can have a non-elective safe harbor contribution, which that gives all eligible employees a 3% of pay contribution, regardless of whether they contributed to the plan. So that is not a match. It's just a 3% across the board. And both types of contributions, whichever one you would choose to make your plan be a safe harbor plan, are 100% vested. So at that point, I'm going to turn things over to Charlene now that I went through some of those 401k basics, and she's going to jump in on the moving pieces in a 401k plan.
Let's see if we can remember how to do this. Share. Okay, can we see that?
Yes.
Perfect. All right, hello everyone. Thank you, Christine. We're going to go through some items here on, Christine talked about essentially plan money getting into the plan. Now we're going to talk about some moving pieces and how those monies are distributed from the plan as well. As Christine mentioned, there are a couple of companies that are involved in the retirement plan. The first, the record keeper, which is where the money is housed. That would be managed in a multi-manager investment portfolio. They track the investment transactions and provide reporting like quarterly statements and education on those assets. Then, of course, you have the third-party administrator, which is Nova. As Christine talked about, we have the compliance testing and consulting that we are involved in, and also providing the optimal plan design. So Christine gave some options for safe harbor plan. If you feel like you're interested in something like that, reach out to your plan manager and we can take care of getting that plan design implemented for you. We also have distribution and loan expertise. So if you have a participant, and we're going to go over some options of how to get the money out of the plan, and we can help you with those participants and let you know if they're allowed for those distributions. And then, as Christine mentioned, the government reporting and disclosures. So there are some notices that are needed to be provided to participants, as well as the 5,500 government reporting annually. And then lastly, we have the investment provider, or the investment advisor, I should say, financial advisor, broker, some other terms that are used. But they will also have a client relationship where they will consult with you with the funds that are available to participants and the fees that are being provided. And then also they will help with enrollment opportunities for helping with participant education and enrollment meetings. And typically they will have an annual review with you or the board members and talk about everything that's happened through the year, look at the fund selections, how they were working for you, and see if there's any opportunities to change the plan and upgrade any of those functions that you're involved in. So when we talk about moving pieces, we want to talk about how money gets to the record keeper. And typically there is a secure website that's provided by the record keeper, and that is where you will upload that contribution information. Christine mentioned a 360 integration, so that's possible that you have that from your payroll provider, and that information will go directly from the payroll system right to your record keeper. That is the most efficient way and actually ends up having less errors, because the alternative is to manually upload that information via spreadsheet or hand enter into the record keeper system. So to prevent errors, we definitely highly recommend the integration method. When that information is uploaded to the record keeper, those contributions will be tracked separately for reporting purposes. So if you're uploading, for instance, pre-tax deferrals, Roth deferrals, we'll use safe harbor match since Christine just talked about that. If you're uploading those 3 different types of contributions, the record keeper will be tracking those sources of money separately. Matching contributions, who calculates the matching contributions? Well, there's a couple of ways. The first is if you contribute pay period by pay period, which means each pay period that you have deferrals, a match is also calculated and deposited for those individuals. In that circumstance, those matches are typically calculated by the plan sponsor. So you as the plan sponsor or the payroll company. And so what the payroll company will do, since this is not a payroll function as far as the paycheck and affects the participant's pay, is they will create a note section and complete that calculation for you. And so if you do have that payroll 360 integration, that amount can go directly into the participants' accounts with the deferrals that's been calculated. But otherwise, they can provide the report with those notes sections that will have those matching amounts that you can provide to the to the record keeper. So that's a pay period by pay period allocation. And a lot of plan sponsors use that because participants like to see their money being deposited pay period by pay period, whether it's their deferrals or their matching contributions, that needs to be deposited together. If you'd like to only make one deposit per year, and maybe you decide sometime through the year about the match, then you can deposit that annually. And how that would be done is when we get your annual census data after the end of the year. So we're coming up on the end of the year now. Provide that data to us early January, and then we can calculate the match for you. And then we will provide a spreadsheet as well, indicating how much match per person. And you can use that spreadsheet to upload to the record keeper. As Christine mentioned, we prepare 5,500. So unless this is a special engagement, NOVA is always going to prepare the 5,500 for you. So once we are finished completing the annual compliance testing each year, and we'll go through the annual calendar, we will then prepare the 5,500 draft and send it to you for review and for electronically signing and submitting that to the Department of Labor. Always on the top of a participant's mind is how they get distributions from the plan when they terminate employment. And so the best suggestion we have for you is to provide that information for a distribution to the participant at their exit interview with their COBRA paperwork or whatever other notices that you need to give to the participant. This will make sure that there's a process in place where the participant is getting that information. And then also it will start the clock, if you will, on the participants being a terminated employee in your plan with an account balance. They can be provided a notice that says, if they don't provide distribution elections within 30 days, their funds are going to be moved to an IRA outside the plan. And that would be for any participant who has $7,000 or less that is terminated. Most record keepers allow participants to request distributions online, and that's what we would advise, is that a participant just go online, request their distribution, and take it electronically. Some participants, of course, are going to want paper forms, which is fine, but we just find the most efficient way is if a participant goes online and requests it there. As we talked about just a minute ago, there are lots of notices that are required to be distributed to participants, and some of these depend on what provision you may have in your legal plan document. The first two here they're going to be notices that are required for any participant. The summary plan description, that's more of a layman's term booklet that's provided to participants that outlines the provisions of the plan. So as a plan sponsor, you would keep the adoption agreement, which is the legal plan document with the provisions, and that's the legal plan document that is signed and executed for going into law for your plan. The summary plan description is still going to be a legal document, but it's going to be more of a layman's term booklet that outlines question and answers for participants rather than all the legalese that's included in the adoption agreement. So that summary plan description is required to be distributed to all participants, and we would advise that you distribute that with their enrollment materials. Again, that way you have a procedure in place, they're receiving everything at once, and you can document that that's what your procedures are. The second item here is the summary annual report. As Christine discussed, that there's a 5,500 that's required to be filed each year for every retirement plan. The summary annual report is typically a one-page summary of that 5,500 with all of the pertinent details. For instance, the total distributions that were processed, how much earnings there was in the plan. And again, this is on a plan basis, not a participant basis. But that summary annual report is required to be distributed to participants after the 5,500 is filed. The annual safe harbor notice, again, if you do allow the safe harbor regulations in your plan or provisions in your plan, it does require a safe harbor notice. So in addition to the required contribution that Christine mentioned and the 100% vesting, there's also a requirement of an annual notice. And that notice must be distributed to participants by December 1st, prior to the year it's effective. So for 2025, the required date would have been December 1st to distribute that notice to participants. The next item here is a special tax notice. And the good news on the special tax notice is it's usually not a separate notice. It's usually part of a distribution form. Most record keepers have now integrated those two items, making it easier for you to give to a participant with the distribution form that outlines how a participant will be affected in taxes if they take a distribution in cash or if they roll over to an IRA or another employer's retirement plan. That special tax notice will outline all those details for them. The next item here is the annual 404A5 fee notice disclosure. And so what this is it's a fee disclosure to participants of what fees that they could be charged, whether it's from the funds that are elected in the plan, or if they take a distribution or a loan, all of those fees would be outlined to the participant, and that's required to be distributed annually. Typically, the record keeper will distribute this notice for you, but I would check with them to make sure that your record keeper does that. If not, then make sure that you know where to get a copy of that from the investment provider and distribute that annually. Qualified Default Investment Alternative Notice, the QDIA, and again, Christine mentioned this near the beginning of the presentation, where you need to have a qualified default investment alternative in place, which is usually a lifestyle or balanced fund, in order to have participants default enrolled if they don't fill out an enrollment election. And again, that's required to be distributed annually. And typically, again, this is required, or rather distributed by the record keeper as well. So I would check with them to make sure that they are distributing that for you. And lastly, annual automatic enrollment notices. So a lot of plans are structured in where a participant will opt into a plan. You can structure the plan to have an annual automatic enrollment, which means that participants would need to opt out of the plan. So if they don't opt out of the plan, they would automatically be entered into the plan at a certain rate of percentage that you've elected in the plan. And that does help participants save for retirement. Because a lot of the non-savers are because they're just the general inertia. People don't want to go out and fill out forms and worry about, they might feel nervous about doing it or just not take the time. And so an automatic enrollment plan would take that inertia out of that participant's hands and go ahead and enroll them, and they hopefully will be happy that they're saving for retirement, and you've taken that requirement out of their hand where they had to go ahead and enroll for it. If you have a lot of notices that you need to distribute, again, you could, if you have a lot of these items in your plan, that could be a burdensome task. We do have a sister company, if you're not already aware, that's AFS, and they are a fiduciary company, and they take care of lots of different things that could be taken care of as far as administration. But one of those items is to distribute those annual notices for you. If that is something that you are interested in, please jot down this email address, and they'd be happy to provide you with a quote for those distribution services. The next item we're going to get into is how to get money out of the plan and go through some distribution basics and then some loan basics. So of course, once money goes into the plan, there are certain circumstances to which it can be taken out. And some of these are optional. But typically, the more options you have available, the more secure a participant will be that if they start putting money into a plan, but then happen to need that money for some reason, they have some assurance of reasons that they can get the money out of the plan. Of course, a lot of participants will want to say that the money's mine, I should be able to take it for any reason. But unfortunately, that's not true. And I say unfortunately, but really it's fortunate as well, because the money is going into the plan for retirement purposes. And so we do want the participant to have that money at retirement rather than taking it anytime during the life of the plan. But a couple of reasons that participants can get money out of the plan. The first is going to be termination of employment. So of course, if they terminate employment, they can take a distribution from their plan. They can decide to take that in cash, roll it to an IRA, or even to a new employer's retirement plan, or any variation of those, really. They can divide it up as well. The second and third items here are optional, age 59 and a half, and we'll go through those circumstances, and hardship. And then, of course, unfortunate death or disability would be required in the plan. So termination of employment, death or disability are required to have in the plan. Age 59 and a half and hardship that we'll go over is optional for the plan. If a person does terminate, again, we suggest that you have those withdrawal forms or instructions available to them at their exit interview, and they can submit a distribution before their termination date if they know that they're going to have a termination date, but those funds cannot be removed from the plan until their last day worked. Again, they just don't qualify for a distribution until they've terminated, so it can't be processed till their last day worked. Most record keeper forms will ask what the final payroll date is, and that is just to keep a participant from having multiple distributions. Of course, we can have multiple distributions, but typically that final payroll should be submitted before the distribution is taken, and that will avoid the participant having two distributions, which will more than likely incur two different fees for the participant. So the most efficient way is to, after the final payroll contribution is submitted, then the participant take a distribution. And then, of course, like we just spoke about, provide that special tax notice, which is almost all circumstances going to be part of the distribution form itself. So we talked about the optional ways to have money withdrawn from the account, and one is age 59 and a half, or what's often referred to as in-service withdrawals. An in-service withdrawal is when a participant obtains the age of 59 and a half. They can take the money from the plan for any reason, and that could be 100% of their account or a portion of their account. And that also will not have any negative effect on them putting more money in the plan. This is just a purely distribution. It doesn't affect any additional contributions to the plan. But this just allows participants to start readying for retirement. So once they turn 59 and a half, they may want to move some money over to their financial advisor's brokerage account, or take it in cash, really. But any reason that they want to start preparing for a retirement, they can take that money for any reason if they've turned 59 and a half and are still working at your employment. Hardship withdrawals are also optional, and hardship withdrawals are very specific reasons, and I think we have a listing here, very specific reasons for which a participant can take a withdrawal. There are new regulations under Secure 2.0 that allows a participant to self-certify, and they would sign off to say that they've met one of these requirements and therefore eligible for a hardship. Alternatively, you can request that they provide documentation of one of these hardship reasons, and that documentation should be submitted with the hardship form. Generally, these hardship withdrawals are subject to a 10% early withdrawal, so a participant should be aware from that special tax notice that they're going to be charged a 10% early withdrawal tax if they're not over 59.5, but then also that they're going to be taxed on that money as well. So even though it gives a participant an outlet for access to their 401k account in case of emergency, it should still be used as little as possible, in my opinion, because of the 10% early withdrawal fee and also the taxes that will be charged on that money withdrawn. Unfortunately, we do have participants that pass away, and those funds are going to be distributed according to the participant's participant's beneficiary election. I hope that everyone has a beneficiary election on file. If not, maybe get with your record keeper if you have a lot of people that don't have elections on file. They can start a campaign to those participants and send notification to the participants that it's important to have this beneficiary election on file. If they do not have a beneficiary election on file, there is a hierarchy to which it is paid, the money in the 401k plan. The first is married participants will always be distributed to their spouse. And so it's important, if a participant does not want to have their spouse as their beneficiary, that they have a beneficiary election on file, but also that that spouse will need to consent to not being the beneficiary. Another withdrawal is a required minimum distribution. Beginning in a year that an employee or former employee turns 73, employees must begin taking money out of the 401k plan. And if you're familiar with retirement plans, you may have seen this age go up in the years. It used to be a 70.5 withdrawal, then we went to 72, so we went 73, and actually in 2033, that age is going to be increased to age 75. So at age 73, currently, a participant is terminated. They're required to take a distribution from the retirement plan, and that is factored depending upon their account balance and their age factor. Then we would determine what that required distribution would be. If you have a non-owner employee that's still working for you, they can delay taking that distribution. So if they're actively employed, they can elect not to take that distribution. However, if they are an owner, employee, or family member of those owners, they will be required to take an age 73 required minimum distribution, regardless if they're actively employed or terminated employment. So there's a big distinction there between the owners and family members versus non-owner participants. Another distribution would be a qualified domestic relations order, and this usually comes up in the context of divorce, but can be for multiple reasons. Maybe a child is involved as well, but typically it's a divorce. And what this does is it allows in the retirement plan for a certain amount of that account balance to be distributed to an ex-spouse or a dependent. And that's usually an order that comes signed by a judge. And the rules can be very complex. There are multiple items that must be contained in that domestic relations order in order to deem it qualified and to be used. So please get with your account manager and contact them with that domestic relations order that's received. They will have our team review it and make sure it's qualified, and then come to you with the next steps in dividing those account balances. Spousal consent. So most plans do not require spousal consent. So a participant could take a distribution or a loan at any time from their account balance and not require spousal consent. There are some plans that do require spousal consent, and it's usually an older provision that we see, a money purchase pension plan that has that you've put into your retirement plan. and that money must be signed by spousal consent if the distribution is more than $5,000. So if we don't have $5,000 in that money purchase pension money, then it's not going to be required, but over $5,000 is going to be required. So that's usually the only circumstance with spousal consent. Another option in the plan, and this is also optional just as the in-service withdrawals and hardships, is a loan. And the loan has quite a few regulations that go with it, but essentially it's money that's withdrawn from the plan and then repaid through an amortization schedule through payroll deduction. So the amortization schedule would come up with the amount of payment, and that would be entered into the payroll system, and that would be the only way that those loan repayments would be made other than the final payment. If there's a final payoff, the participant can submit a personal check for that to the record keeper. Otherwise, it would always be made through payroll deduction. And these are popular with participants because they can take money out of the plan, repay it. They're not taxed on it because they are repaying it. And it's just easy for them. They can take the money out and then it goes through payroll deduction and paid back to their account. There are, again, regulations around the loans. A participant may borrow the lesser of 50% of their vested account balance or $50,000 reduced by any additional loans that they had outstanding. So in no circumstance would there be a loan for more than $50,000. And then also we have typically recommend putting a minimum loan amount in the plan of $1,000. And that's just so we can prevent the plan from becoming a savings account. People just putting money in, taking out, putting in and taking it out. So if you have that minimum, then they would need to have, as we talked about, is 50% of their vested account balance can be taken. And so that participant to get $1,000 loan would need to have $2,000 vested account balance dollars in their account to be able to take that loan. The loans also must have a reasonable interest rate, which typically is deemed at 2 percentage points higher than the prime rate. The loans must be repaid within 5 years unless it's taken for a residential mortgage loan. So if a participant would like to take money down for closing costs or a down payment on their principal residence, they can take a loan out for that purpose, and it can be repaid in more than 5 years, up to 20 years. So elongated time frame there that they can take out only for the purchase of a principal residence. Otherwise, all loans must be 5 years or less. Again, it's paid through payroll deduction on a post-tax basis. So this would not be on pre-tax basis. Any loan repayments are post-tax. And then typically the loans become due upon termination of employment. So a participant takes a 5-year loan and then they terminate after 2 years. Then that loan would become payable. They can either pay that loan off in lump sum, or they can what's called default on the loan. And what that means is it's not any implication to them as far as their credit score or anything like that. It just means that that money is now taxable. So whatever they owe on that loan would be reported on a 1099 and then reported on the participant's tax return. There are typically fees for loans. There could be a loan origination fee, but then also annual or monthly maintenance fees that are provided by the record keeper. And the participant does bear the cost for those loans. So when a participant requests a loan, that loan fee would be taken out for the processing and then out of their account balance at the record keeper if there are any annual or monthly maintenance fees. The fastest way to get a loan, we talked about the fastest way to get a distribution. Fastest way to get a loan is apply online if you have that functionality, and then request an ACH debit instead of a paper check. All right, so we've talked about how to get money in the plan, how to get money out of the plan, what our compliance is through the year and reporting, and now we're going to go over the annual calendar. A lot of these are going to be duplicated, so I'm not going to go through every one of these, but I just want to hit on some key points. The first is going to be the 1099s. As we talked about, there are distributions that are taxable. If a participant takes distribution in cash or they default on a loan, they will be required to have a 1099, and that will be distributed to them from the record keeper no later than January 31st. Also, the first week of January is when we're going to start requesting your census data for the prior year. So we're coming right up on that. First week of January, we're going to request this annual data for 2024. If you haven't already, I know that Christine mentioned our plan sponsor link where you can upload a secure file. That's also the website that will be used to upload your census data, as well as answer a questionnaire regarding 2024 data. That questionnaire will include things like who the owners are, who the officers are, and request the census data as well. And that census data will include name, social, date of birth, date of term, compensation, deferrals, matching contributions. All of this data is used and compiled to complete the testing that Christine had mentioned earlier, the deferral and matching testing, top-heavy testing, coverage testing, all of the different testings that's required each year. Also in January, it's going to be when your participants are receiving their fourth quarter statement from the record keeper, or annual statement, depending on what's set up at the record keeper. It's also an entry date for semi-annual, quarterly, and monthly plans. So again, as Christine mentioned earlier, there's some limitations on the eligibility, and one of those limitations is how often a participant enters the plan after they meet the eligibility requirements. So if you have a semi-annual entry into the plan, which means a participant's entering January 1st or July 1st, January is going to be an entry date. So that's when you will provide those participants before that January date their enrollment materials so that they can ready for enrollment as of January 1st. You can get that data into the payroll system. Let's see, February, again, January, February, March are very busy times at NOVA because we have a deadline of March 15th we have listed over here, in which any plans that are subject to the ADP ACP testing, which would be any plans that are not subject to Safe Harbor. So if you have an ADP or ACP tested plans, if that plan does not pass, there are refunds that need to be processed from the record keeper, and those refunds must be processed by March 15th. So if you look at the calendar here, it seems like a lot. You have a lot of time. You have January, February, and March 15th. However, those refund forms are typically required to be provided to the participants a minimum of 2 weeks prior to the March 15th deadline. So that would only give us January and February to complete your testing, receive the census, scrub the data, complete the testing, get the refund forms written up for you to signature ready for you to sign and submit to the record keeper. So a very short amount of time in those 2 months to get all of the testing done. And so the earlier that you can provide that census data in January, the better chance that you will have of meeting that March 15th deadline. If you don't meet the March 15th deadline, it's not the end of the world. Your plan won't be disqualified. However, if your plan does not pass and you have refunds that are needed, there is a 10% excise tax that is required to be paid to the IRS because of that because of that late refund. So again, not the end of the world, but we would rather have you not pay 10% penalty and get that completed for you. Let's see, again, there's lots of entry dates here depending on your plan, so just read through this calendar depending on what your entry dates are. April 1st is also a deadline. So April 1st is the deadline for RMDs, required minimum distributions that we talked about at age 73 that were deferred from the prior year. So for the first year of a participant being required a required minimum distribution at age 73, they can defer that requirement until April 1st of the following year rather than by December 31st of the current year. So again, that's a deadline for those to be distributed. Another deadline is an excess 402G refund, and that is for a participant who exceeds the amount of annual deferrals that are allowed that year. For 2024, you may already be aware of this because we're at the end of the year, was $23,000 plus $7,500 catch up for those 50 and older. So if a participant exceeded this limit, they would need to receive that excess 402G refund no later than April. Unfortunately, that there is a penalty for that as well if they don't receive that by April, and it's 50% of what should have been withheld. So it's very important to meet that deadline. But if a participant had a separate employer and then came to your employment, you may not know of that excess until the participant brings it to your attention when they're doing their annual tax return. Let's see. May, once we get that testing completed, we're going to start working on your Form 5500. And for large plans, if you have over 100 participants with account balances, we suggest that that's when your audit should start as well in May. The first due date for an annual 5500 is going to be July 31st. And so we want to make sure that your audit is done in time for that. And in order to do that, we would suggest starting as early as May on that audit. Again, we talked about the 5500 due date. There is an extension that can be provided, and that extension would be October 15th. So as of October 15th, that is the extended due date that all 5500 should be filed, whether they have an audit requirement or not. We talked about the notification of summary annual report. That's required to be distributed by July 31st. By September, if you submitted your 5500 by the July 31st deadline. Let's see, I just want to see if we have any more that we have to hit on. A big one again is that sending notices by December 1st. If you have an auto enrollment plan, safe harbor plan, make sure they're processed by December 1st to participants. And if you have the record keeper, just make sure that they're either sending that default investment notice or not. That may be one notice that you need to distribute. Let's see, I think that might be all for the annual calendar. I know we're running short on time here, actually we're over time. We'll have a webinar schedule coming up for any additional webcasts. And so check our website probably the end of this week or next week for that calendar. Again, if you need CPA credit, you'll receive an evaluation survey, and then you'll receive that certification within a week of the webcast. We really appreciate your time and going through all of these provisions and the plans. And we're leaving our contact information here. If you have any questions, you can reach out to us directly. I'm not sure, it doesn't look like we have any questions, so feel free to reach out to us or your account manager. And again, we really appreciate your time and your partnership with Nova. Christine, do you have anything else?
I'm good. Thanks for joining us, everyone.
Thank you, everybody, and thank you again, Christine and Charlene. Just a few reminders, you can get the PDF version of this presentation on your go-to panel. There'll be a little paper and paperclip icon at the top of your screen. If you aren't able to download that, you can email us. There will be the pop-up survey once the session ends. If you have any further questions, you can go ahead and reach out to Christina and Charlene, or you can email us at webinars@nova401k.com and we can forward that over to you. To view any webinars you may have missed on the recording of this session, you can always follow us on our YouTube channel, which is Nova 401k Associates, or you can follow our website at www.nova401k.com/webinars. Thank you so much, ladies. You guys have a great day.
Thanks, everyone.